Cool beans, cool beans. Welcome to the weekly wrap up, ladies and gentlemen. I'm gonna go ahead and pass it over to Carmen so she can give you the fundamental wrap up, and when she's done, I will give you the technical wrap up. It's all yours, Carmen.
Cool. Hey, everybody. So I'm not going to share my screen because I'm actually going to keep it pretty short and simple because everything that's happened this week has been anything but short and simple, but it can be summed up. Last Friday, technically last Thursday night, we saw the banking system in the United States start to show some cracks in the system. Um, in regards to how banks try to provide some safety for their customers, but then how the Fed in raising rates to counters that. So there are those who are wondering, well, bonds and certain investments, they're supposed to be safe. How is it that it's now hurting banks? Well, when you think about what's been going on, and you think about how people tend to be safe, their long-term investment. But when you have interest rates going up and you have the value and price of bonds coming down, if you hold on to it, yes, you can probably weather through the short-term interest rate difference that is causing the difference in price. But if in the short term have customers coming back to you saying, no, I need to withdraw that money. So money you've invested to help not only the bank make money, but also be able to provide a spread and be able to provide, a decent return for your customers. If you have to cash in on those investments early is when things start to take a turn. That's some of what happened with Silicon Valley Bank. And then um, some of the other banks were having the same issue. Silvergate is a little bit different because Silvergate is crypto. Um, if you heard lately, there was actually um, someone within Silvergate, someone that actually had corporate responsibilities, say that the collapse of Silvergate was an anti crypto move. So take that for what you will, read it, take the information from an article, soak it up, think about it. But anyway, I think each of these situations with the banks now is just kind of starting to have like repercussions everywhere. So Silicon Valley Bank, not only just a bank for businesses, big businesses in Silicon Valley, but also startups. You also had those who are those who had a lot of money that live in that area that put money into those the bank as well. And then companies that have other locations need to make payroll and so on and so forth, pay their bills. That money was caught up in that bank. So when a lot of people say no, let the bank fail, well, that means that you're working for a company that banks with SVB who might not be able to make their payroll. And then guess what? If you're saying, yeah, let the bank fail, and then your company can't get money from the bank to pay payroll, then guess what? You don't get paid. And you can't be mad at the company because the company has their money sitting in the bank and they just can't get it out. Or because of the amount that was there, lost. So that's that. Then later, as you progress through this, we had other issues showing up. Credit Suisse um, really started to show some cracks in the international system. And the thing that really is, some people will say it's a little scary. Some people will say that it's not, but the fact that Credit Suisse is a Swiss bank. And when we talk about Swiss, you think Swiss franc, you think safe haven, you think that's where everybody puts their money. And so, guess where everybody's money is? Credit Suisse. So now you have these Swiss banks that are like, not us. That's the last place, actually, where you would think to look whenever it comes to bank failure. Um, anyway, and then back to the United States. To close out the week, we have First Republic, that had to be bailed out by the big banks. So, when you start to think about banks in the United States, a lot of people have questioned, well, where should I put my money? I don't know where to put my money. I don't, I'm kind of questioning now what I should do. Um, the biggest thing that I could tell people now is assess bank risk. A lot of people say, they open up an account and they do it because it'll give them a good return, a good interest rate, but you have to look beyond that. And really quick, see if I can find this chart really quick. Um, but while I'm looking for it, I'll just keep talking. So, as we are looking at this banking system situation and we're just really trying to figure out what to do, everyone's thinking about where to put their money. Everyone's trying to figure out if they should keep their money in the bank, if they should take their money out. No one can really tell you what to do with your money. No one can tell you how to handle any situation financially when it comes to your money. But the thing to remember is you're going to take on some risk regardless of whether you have your money in the bank or not. And I say that because if you have all of your money at home, then you're going to be sitting at work or going out wondering, is my money safe? Is, you know, whatever you have going on at home, is my money good? Someone going to break in and take my money. So you have that to worry about if you take all of your money out. If you have your money in the bank, at least you have some, you could say insurance or security when it comes to it, because at least it will be sitting somewhere where you can get a coupon or certificate from the FDIC and you can transfer it. So the picture that I was looking for, I found it. I'm going to share it. All right. So um this may or may not be super clear. I'm not going to read all of these banks to you, but when we start thinking about First Republic, for instance, the bailout that happened with First Republic, and it wasn't like a public bailout, it was a privatized bailout that happened amongst the big banks. So this is why I tell you guys to also know like the names of CEOs and the names of people like in C suites across different banks, because you want to know names when you hear them in the news. So like a news article that I saw today said Jamie Dimon in the middle of another financial crisis. And I'm thinking to myself, who did he help this time? Because if you know Jamie Dimon, you know Jamie Dimon is associated with JP Morgan. And if you know JP Morgan and you know what they did during the last financial crisis, then you know they took on troubled assets during the last financial crisis. So I knew that when I saw that headline, okay, he helped somebody. So I was like, what bank is it? Who did he help this time? So it was First Republic. They actually came together, JP Morgan and other banks, to raise $5 billion to help First Republic. But this chart that you see on your screen is um troubling when you look at it. It's quite as well. So the arrow that you see is pointing to Silicon Valley Bank. So Silicon Valley Bank had a um cumulative asset risk level of like 63. Um, all of the banks to the right of that arrow have more risk. Um, and those are banks like Fifth Third, Morgan Stanley, Ally Bank, HSBC, American Express, Discover, Signature, which we've already into Signature, for Citizens, Santander. Um, I was trying to go through and just read the ones that are like ones that you really see, or that are really popular. Some of the other ones just aren't quite as well known. But so the ones that I did name are to the right. So those are significant companies. American Express might surprise some people because they think more credit cards, but you have to think these are issuing companies. So their asset off well is a little bit because like Discover, American Express, they have credit cards, they do unsecured loans, they do personal loans, student loans. So they do a lot of loaning of money. So the scary part and the high risk factor that they take on is the fact that they have given people money that people may or may not be able to pay back. But to the left of this arrow are banks that have significantly less risk. And if you look, the very first bank, speaking of Jamie Dimon, is JP Morgan. So JP Morgan, followed by Bank of America, Citibank, Wells Fargo, US Bank, PNC, Truist, Goldman Sachs, Capital One, TD Ameritrade, Bank of New York Mellon, State Street, Citizens, First Republic, um, Morgan Stanley Private. So you see, as you get closer to that arrow, these are like banking systems that you've already heard a little bit about, like First Republic. And Morgan Stanley, their balance sheet isn't really all that great either. And you would think, considering that they made it out as unscathed as they did, I mean, bruised and battered, but they made it out of '08, that they would have gotten themselves together. But those banks that are actually to the left of that arrow are some of the banks that came together and put this money together for First Republic. So, again, if you were just looking for a bank, you want to look at a bank that doesn't have significant balance sheets, a lot of risk. You want to look for banks that are like, well, capitalized, um, banks that are solid. And this is one way to look at it. There are other factors and other websites as well we can look at a later date. I know some people don't like Bank of America, Wells Fargo because of their rates, because of some of their banking practices. But here's the thing. You have to take a little bit of bad to get good. So if you want a good solid bank, sometimes you're just going to have to kind of bite the bullet a little bit, on some banking practices in order to make sure that whenever you put your money in a bank, you have a decent chance of actually getting it back because the bank actually has money. And then with JP Morgan as well, JP Morgan is JP Morgan Chase. So if you see a Chase Bank, that also falls under the same umbrella as JP Morgan. So, oh, and people who had SunTrust or BB&T, those banks are now merged together into Truist. So hopefully that merger has been around long enough that you know Truist is actually your bank. So when those two banks merge together, the balance sheets actually meshed fairly well so that they don't have a lot of risk. They do have significant risk, but it's not too bad. And I think it was nice that Truist and SunTrust were both relatively small banks at the time. and had a good solid customer base, and they had really good individual balance sheets anyway. For the most part, I mean, they did have things, but brought together was a good combination. So um, that's that. Some things that I'm going to be looking at going into next week, though. Obviously, this banking situation is not going away. Um, we did have CPI come out this week. It was relatively flat, pretty much on par. All the other news that came out this week just wasn't great. Producer price index, retail sales, confidence numbers, unemployment claims were up, um, consumer confidence was off, inflation expectations were about 3.8%. So going into next week, obviously carrying over this same sour sentiment. It sucks to say that, but that's just how it's going to be. Um, Tuesday, existing home sales. So that will help us to get a down the line, futuristic kind of view of the market. Followed by FOMC statement and Fed's fund rate. The expected Fed's fund rate is expected to be 5%. Like, if you have not been tracking how many increases we've had and what the increases were, like, we're approaching 5%. My goodness. The other one that is going to be super important next week is the Swiss franc. My goodness. They are anticipating a 50 basis point increase in interest rates next week. So please pay attention to that. And on top of that, we have the GBP doing the same thing on Thursday. So we have a lot of rate news coming out next week. So if you anticipate being in the market next week, Tuesday it should be your last day. You should not even think about trading on Wednesday because Christine Lagarde speaks that morning, and all up until Jerome Powell comes out with the statement, and he's not going to speak. Wait, hold on. The statement's going to come out, and then he's going to speak at 2:30. So up until he comes out, the market is going to be in flux because it's already turmoil. It's already, I shouldn't say turmoil. So already a lot of volatility going on in the marketplace right now. So Tuesday should be your last day. Wednesday should be your sit back and watch day. Thursday should be your sit back and watch day. We also have unemployment claims, which are going to be heavy news. If you fast forward and look at the Forex Factory calendar, you know, if you've looked at it in the past, unemployment claims is usually orange. Next week, it is red. Please. I mean, I'm not going to beg you, but I'm just trying to give you a heads up, just not to be in the market after Tuesday. But if you choose to do so, okay, it's your account. And then Friday, we have every currency that we could possibly look at releasing some type of flash manufacturing services, um, retail sales, durable goods, like something from every currency is coming out on Friday. So next week is starting on Wednesday. It's going to be a pretty interesting week with everything that we already have going on. And then adding to that what we will be having go on for the end of the week is just really going to it's going to make the volatility in the markets just that much more great. Those news items that are coming out next week already tend to increase volatility anywhere from 25 to 35%. NFP causes the most volatility, anywhere from 60 to 80% volatility in the markets for that particular trading day. So you can expect that much more volatility on top of the already high volatility that we have just based on news. So um, I would expect Jerome Powell to address the banking situation, also address how he plans to go forward with rates based on the current banking situation, and how he's planning to work with regulators, regulators being um, the Financial Stability Committee, which he sits on, working with Janet Yellen, working with the FDIC, working with local regulators, working with regional Fed leaders, working with, I feel like I'm missing one. Um, I'll drop it in the chat when I remember. But working with all of these people to try to make sure that what happens next is going to be good for both the financial markets, but also to help with the overall goal of trying to lower inflation, because you have to think about it like this. They're not the same goal. Lowering inflation is going to require an increase of interest rates. Helping the financial markets and the stability requires not raising rates or lowering rates, which is going to be counter to the whole goal and objective that the Fed is trying to achieve right now. If the Fed is not able to achieve the goal they've currently set out for, you either end up with, well, you will end up with runaway inflation, and you'll end up with a fairly stable market, but that runaway inflation is going to cycle back around to pretty much cause the same thing that a recession would if we reversed rates. So it's just a matter of which one of the scenarios can you best control if it happens. If you get runaway inflation, you know you have to increase rates. If you decrease rates and you get a market kind of tumbles and spirals, then how much control are you going to be able to get on the markets if you reversed? So it's a couple of things with that. Hopefully, fingers crossed, I can be on the call Monday. We'll talk about it more. If I know that I'm not going to be on the call Monday, I'll just make a really long voice note and you guys will just have to listen to it and I can explain, and we can just talk about it more. But I want to see those things next week, or those are things that I'm going to be looking for. But this weekend, I'm just going to be looking at um, any news about the banking system, any different, anything new, any developments, and then also following that into Sunday night, Monday morning, when the markets open up and kind of adjust for the things that they couldn't adjust for, since their markets were already closed. But I'm done. I'll go ahead and turn it over to Mr. Levels and let him get started with the technical wrap up.
Cool beans, cool beans. Appreciate that fundamental wrap up, Corman. Saucy as always. Let's see what we got for for technicals, guys. So, looking at technicals and starting out with DXY as always, we see that the agenda for this week, starting Monday, was we wanted to see how price action opened up, reacting to last week's order flow in the new week opening gap. And so Friday, I told you guys, if we opened up and we opened up below the new week opening gap with aggressiveness, then I would want to see us come down and run Friday sell side liquidity and fill in this the rest of this imbalance that we see here, and possibly come down to fill in this imbalance here and get down into this daily fair value gap. That was the agenda from the beginning of the week, leaving um that was the agenda leaving last week coming into the beginning of the week. So as you can see, we had our premium array of Fridays, down close candle mark. We had our buy side liquidity above Friday's candle, sell side liquidity, which I have moved now that we ran that liquidity. But we had our sell side liquidity on Friday, sell side liquidity mark in our new week opening gap. So Monday we opened up clearly aggressively to the downside, which lined up with the agenda. And I told you guys that we would want to see price action run Friday sell side liquidity. We seen that happen. However, once we got down into this market structure here, into this daily fair value gap there, we seen price give us unwillingness to break this market structure and continue to push lower. So on Tuesday, we had a fairly uh, stagnant day, consolidated day. Price open and closed within the same range, within the same level, price level. So we opened at 103.673 and we closed at 103.673. And Monday's down day gave us a new sell side liquidity. So Wednesday, we seen price come down and run Monday's sell side liquidity. And we pushed up into Friday's premium array. That's what we wanted to see if price would have opened up above the new week opening gap on Monday. However, being that we opened below aggressively, then we went with the sell side agenda, right? We went with the sell side agenda because remember, you always have two agendas. You can have a bullish agenda and you can have a bearish agenda. So once we opened up with the bearish agenda and we ran sell side liquidity, we are still paying attention to Friday's premium array because it hasn't been checked yet. And we see there's a lot of imbalance to the upside on this daily chart for DXY. And so when we see the consolidated market Tuesday, we can start to draw our attention first back up to the premium of Monday's candle, right? Because we have to get up into that premium first before we can start targeting new week's opening gaps in Friday's premium, right? But we see price action just blew through Monday's premium and the new week opening gap. And so we already know we're looking to see how price reacts to those levels for the new week opening gap and Monday's premium array, right? So Monday's premium array would be up in here. And we see price action just blew through that, right? Price action blew through the new week opening gap. So we know when we see those levels broken, we want to see um, how they are broken and how price action reacts to those levels. Um, so I'm gonna have to break it down from the hour, right? So we see for the most part, when we got up into Monday's premium array, we blew through it, um, created some fair value gaps in price action, right? And price continued to run through the new week opening gap. And when we seen that, I told you guys that when we seen that, I would want to see price blow through it aggressively, and then we would look to enter long positions off of new week opening gap up into Friday's premium array, and then we will see how price action reacts to the premium array. And so we got that aggressive breakthrough there, beautiful retest out the new week opening gap straight up into Friday's premium arrays. And so we see how price action reacted to those, both of those levels, the 62 and the 79 level, right? Gave you a pullback at both of them. And then we see price start to make lower highs and lower lows off of the top premium array level. And then from Wednesday on into today, um, well, Wednesday evening, right, Asian markets on until closing today, we see price action come back down to retest um, Monday's premium array here. So going back to the daily, we see how opening up the week with a bearish and bullish agenda, having your targets already set, right, in the form of your buy side and sell side liquidities and your PD arrays and your new week opening gaps. We see how we can just allow price to come to us. We can allow price to show us, tell us what it wants to do. And then we can use that information to get in position and execute our trade. So this week it played out beautifully, even with all of the um, news, high impacting news that we had released. You can see that if you just sit on the sideline and don't try to trade ahead of news, let news play out, then the algorithm is going to deliver the price. The algorithm is going to deliver price action exactly how it was intended to deliver price action. So I didn't have much for the technical wrap up, just wanted to go over that for DXY, because we know DXY is basically what we use to gauge our currencies, metals, and futures, because they all inversely correlate with the dollar. So when we were expecting to see the dollar open up the week bearish, we know we was expecting to see currencies open up the week bullish, as we did see with Euro USD here Monday, um, running Friday's buy side liquidity here, right? And then coming up to that market structure, just like the dollar came down to its market structure, respecting that market structure, having a fairly consolidated Tuesday, and then setting a new buy side liquidity Wednesday, right? And then we come back down. We blow through Friday's premium discount array. Sorry. We blow through Friday's discount array. Um, and then I told you guys Wednesday night that I would expect for us to pull back up into Friday's premium array. And then discount array. And then we would need to see how price action reacted to it. We would and depending on how price action reacted to it, then we would be expecting price to either come back down and run Wednesday's sell side liquidity, or we would continue for it to push up into Wednesday's premium array. And so we see the reaction that we got. Price action was fairly aggressive, bullishly aggressive when we got back up into the discount array. And we pushed right up to Wednesday's premium array and closed right at the bottom level of Wednesday's premium array. Perfect. So that was the case for our other currency pairs as well, give or take a little. Yeah. Looking at metals, we see we got the strong push up on metals. Um, we did get that bullish day Monday. However, if you guys recall Wednesday, I was telling you that um, the divergence that I was seeing between metals and currencies was had me worried a little bit because as you can see, we did not get the pull back down into the discount array like we did with currencies. See, we got the pull back down into the PD array um, with currencies, right? Got that pull back down Wednesday, right? But we didn't get that out of metals, right, on Wednesday, right? As a matter of fact, metals was bullish Wednesday, and that's what I was concerned with, and why I told you guys that I didn't like what I was seeing with metals. And so I was telling you guys that um, that led me to believe that Wednesday we was right here for the dollar, and I was telling you guys that um, that was leaving me to believe that the dollar could continue to push up, right? And that would give us that pullback that we needed for metals to get in line with the dollar, right? Because metals shouldn't have been pushing up with the dollar Wednesday, right? So I was telling you that was leaving me to believe that the dollar could possibly continue to push up Wednesday, and that would, you know, should make metals give us that pullback down that we should have seen to the PD array. But the dollar pushed back down to Wednesday's discount array, right? So the metals were leading the DXY Wednesday, right? And showing us where it was getting ready to push to versus the dollar leading, you know. showing us that it was going to go bullish and was going to drive metals lower. So that was the case with that. Um, and like I told you guys, if metals continue to push higher, that I would be expecting it to come up to this fair value gap in this buy side liquidity. So that's where we closed the week at for silver, for metals, for silver in, gold, almost reaching that level that I had marked for buy side liquidity. So very interesting, very interesting. Oil still pushing lower. And I told you guys that I would expect us to come down to the market structure around, was it? I don't think it was that low. I think it was here, yeah, $60 if we took out this sell side liquidity. And it looks like we might have closed. We might have closed like right there at it, which the low of that 66.15. Nah, we ain't closed. So we ran it though. What's the low? Oh no, we did. All right. So we'll see how markets open up for the new trading week. Looking at ES. Oh, this the new contract. This the June contract. Yeah, should guys be looking at the June contract now, not the March. March contract ended today. However, we can see that Monday we seen price action run Friday sell side liquidity. Tuesday gave us the push up back into the new reopening gap, right? And Wednesday we came down to run Tuesday's low, but we respected the order block right here, the daily order block. But if you break down to a smaller time frame, then you will see the breaker block, fair value gaps, and everything up in there. This was a very aggressive candle that came with that news Wednesday, but we closed above the order block Wednesday, right? And that was good indications that Thursday was going to give us a bullish day to run Wednesday's buy side liquidity. And we pushed right up into this daily fair value gap from last Thursday. Beautiful. And today we we pulled back down into Thursday's discount array. So this week was a fairly good trending market um, as far as algo trading, how we trade using, smart money concepts. But this was the setup from Wednesday. I told you guys that we would be expecting price to pull back up into the PD array. And then we would look to see how price reacted to it. So came up into the PD array, respected the PD array, pulled back down into the breaker block, low, high, lower low, break it, pull back down to it perfectly with that wick, And today we came up to run Tuesdays by side. So beautiful, beautiful setup. Um, and so now when we start the new trading week, we will start with the new futures contract, which will be the June contract. So same thing with U30 up into the PD array. Respected it for the most part. It wanted the Aggo still wanted to deliver price up into this fair value gap a little bit more, so we pushed up a little bit over the PD array, but came back down into the breaker block, low, high, lower, low, to come back up and run Wednesday's buy side liquidity. Run Tuesdays. Yes, we did. Ran Tuesday's buy side liquidity today. We ran Wednesday's buy side liquidity yesterday evening, yesterday's close. Well, yesterday around 1 o'clock. And then we ran Tuesday's buy side liquidity today, right before the close. Oh no, this was around 4 a.m. this morning. We ran Tuesday's buy side liquidity. And then from 4 a.m. to the close, we came back down into the PD array, which was Wednesday's PD array. No, Thursday's PD array. So yeah, it was a fairly great trading week trending week as far as smart money concept. Um, yeah, it was basically the same thing with Nasdaq. I don't think I marked Nasdaq up because I don't really look at Nasdaq. And last but not least, crypto. Y'all already know what's up with crypto. Um, we already know once we broke through 25,200, our level that I told you guys we've been waiting to see broken through aggressively. This wasn't an aggressive break. Because why? Because of that wick. A break. This isn't even a break because we didn't close above it. So we see an aggressive push above it and close above it. On a high time frame, which this is pretty high daily time frame. You don't get much higher than that besides weekly and monthly. So yeah, that's what we wanted to see. So you know the next stop, big round number 30,000, or if you want to be a perfectionist, 29,902. But Ethereum already got to our next level, 1,800. That's what we was looking for. That's what we was hunting. So we there. Um, of course. Um, I would say, I would say, I don't know, boy. When crypto get to pumping like this, uh, it's Friday. Stick to the strip. Pay yourself. Take some out. Um, I don't know about Bitcoin though. Hold on, let me see. Is Bitcoin at a level? Bitcoin ain't at a level. Yeah, see, so Bitcoin gonna keep running. We were right up in. Yeah, I don't know. We ain't consequent encroachment of a fair value gap though. So we could see Bitcoin react to here. Because we are at consequent encroachment of a fair value gap. Y'all should know that consequent encroachment is what? Drop it in the chat if anybody know the answer to that. Consequent encroachment is what? But we are at consequent encroachment of a fair value gap. So we could see Bitcoin come back down to retest 25,200. Retest this market structure here, the top of this market structure. Somebody dropped it in there. Consequent encroachment is the midpoint of a gap. That is correct. Ding, 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 ding. The midpoint of a gap or the midpoint of a wick as well. We do use consequent encroachment levels for wicks as well. So yeah. Let's look at 8. Oh man, you ain't getting you some 8 tokens, seeing how Bitcoin and Ethereum is pumping. You gotta be crazy. Because ApeCoin should be back up here at $7, or I mean $6.30. So we probably gonna see that bad boy fly. Yeah, absolutely. Absolutely. So yeah, that's what I got for the technical wrap up. At this time, I'll stop the share, stop the recording, and take any questions.